Here at the New York Stock Exchange, investors can be forgiven for thinking, oh no, here we go again. We're talking about the debt ceiling. Washington has to make a decision about when to raise the $16.4 trillion debt ceiling, otherwise the Treasury will be unable to pay its bills.
I think frustration absolutely defines the way not only investors in this country feel, Americans, just as an American citizen, I'm beyond frustrated at what I view as a lack of common sense coming out of Washington, and I think that sense is echoed across the country by people that are watching this drama unfold not only on the U.S. stage but really on the world stage, because all eyes around the world are looking at, what the heck are you guys doing down in Washington, and why can't you come together?
After a bullish start to the year for equities and risky corporate debt, some are hoping that Washington will cut a deal and spare markets from a bout of volatility.
I'd like to think that there's going to be some sanity in D.C. It may not be the best outcome, but I think it will be one that is the least bad outcome that they can make it. And we saw that with the tax side of the fiscal cliff.
Having addressed taxes under the fiscal cliff deal at the start of the year, now comes the hard part, resolving government spending that runs well ahead of revenues and, of course, the debt ceiling.
They took the easiest decisions first, but in the process they've set themselves up for 3 looming deadlines, not just one. The debt ceiling, the continuing resolution, as well as the sequestration cuts which trigger as of March 1st. I actually think sequestration is the one which has the most likelihood of being triggered. I think Congress will have a much harder time finding its way past the sequester cuts unless we decide that we are just not going to pay attention to our fiscal situation medium term ever.
The consequences for the entire global economy would be catastrophic. Far worse.
One thing is for certain, Washington gridlock could take some time to ease, providing a noisy backdrop for markets in February and March.
These are hard-nosed negotiations, and you don't come up with an answer early. You wait to the end, right? So don't expect anything to preempt in terms of coming to a compromise.
I don't think they're going to take it right to the very end, because they did that a year and a half ago, and then they saw what happened, right? The market punished them, punished Washington for their inability to come together. S&P downgraded U.S. debt. The market kind of sold off hard. Stabilized and then actually came back. I don't think they want to see that happen again, so therefore I think they'll negotiate in good faith. But I do think that if it starts to feel protracted, the market will come under some pressure.
There's also a strong chance that Moody's and Fitch will follow Standard & Poor's and downgrade the U.S. credit rating. A downgrade like what we saw in August 2011 may only encourage greater demand for U.S. Treasury debt. In contrast, the dollar may well be in the firing line as foreign investors take a dim view of Washington.
Foreigners look at the U.S. and the political dysfunction that's going on in the U.S. They have the same reaction that Americans do. It's frustrating, right? They shake their heads, and it does reduce confidence. And I think that they're voting with the stock of America, which is our currency.
On this vote, the yeas are 257.
So what kind of deal will Washington likely deliver, and is one that placates investors and markets?
It's laid on the table.
In my mind, and these are, it's very difficult to defend these probabilities, right? 15% and 25%, there's nothing quantitative here. But the odds of an agreement that the markets can be happy with, I think, are very low.
We may hit some rocky road here in the beginning, right, through February, maybe even through March. But I think beyond that, once we get through these issues, and I think we will, then I think absolutely that the market is set up, because I do feel that there are parts of this economy in the United States that are starting to turn and get better, and then it's a matter of the other ones catching up.
For now, investors seem willing to bet on the side of cautious optimism.
I think that they are cautiously optimistic, but they may be cautiously not as pessimistic is perhaps a better description.
With equity volatility at its lowest level since 2007 and the S&P 500 currently around 1480, its highest level in more than 5 years, it's fair to say that investors are banking on Washington to resolve the 3 big looming fiscal issues. The obvious danger, however, is that Congress and the administration may well stumble in trying to fully resolve their differences over spending and the debt ceiling in the coming weeks. This will undoubtedly cast a shadow over the current bullish performance of equities and risk assets. This is Michael Mackenzie, New York, Financial Times.